Hello, welcome. Thank you for participating to our last webinar for this year with HI Numen Credit Fund. I'm here with Filippo Lanza, founder and portfolio manager for Numen Credit. Ciao Filippo.
Good morning, Laura. Good morning, everybody.
So today we are going to talk about many things, deflation trade, banking risiko, asset bubble, and in particular we are going to touch the new secular trend, which we think have been accelerated by what happened this year, as many dynamics in this market. So I let you start from this first slide.
Of course, thank you. Obviously, we have to start the first slide talking about COVID. I think COVID obviously has been a tragic event, especially from a human point of view. But as we said since the very beginning, when he started in March, our strong conviction would be that humanity would have overcome it, and it would have found the right solutions. As of now, mid of December, we in front of some major achievements where basically not only we have found one vaccine in less than 12 months, but actually we're dealing with possibly 5 pretty solid vaccines. And I think the market may actually be surprised how fast that deployment and the distribution of the vaccines could be in the next few months. We've always been quite bearish on the second wave, but at the same time, very, very positive on the vaccine. Now, COVID, as we said, it will not be a structural issue. It's a temporary tragic event, but it triggered 2 major issues. One is what we call the technological winter, and if anything, it has accelerated that. By technological winter, we means this kind of virtuous super cycle of technological investments. If technology creates deflation, and obviously there are also exogenous shock like the great financial crisis or COVID, obviously central banks bring rates to 0. Mathematically, if rates are 0, any business plan which expects profit in 10 years or 20 years all of a sudden becomes very profitable as of now, because that profitability is discounted as if it were tomorrow. That means actually that because the valuation of the equity and the startup or company is so high, that same company can actually raise a lot of money to make their own business plan self-fulfilling. This year, we've seen a major acceleration of that. We've seen it with Tesla doing 3 capital increases. We've seen with names like Plug in alternative energy, hydrogen space, managing capital increases when their stock went up more than 5-6 times over the course of a year. And I think that will keep on going. That will be very disruptive because it's a self-fulfilling cycle. New startups come up, they can raise money because there's no alternative investments. Their business plan is fantastic because rates are 0, and then they can raise money actually making the business plan true. If any of you invest in tech startups, you would see that happening every day. What we see in the market is just a small version of what's happening on crowdfunding sites out there and in the venture capital environment. The problem with that is that obviously the investments that are happening right now, they're happening into technology which is much more disruptive. The power of an NVIDIA chip now versus 5 years ago is uncomparable, which means the disruption is even stronger. There's going to be very few winners and lots of losers, especially in legacy businesses, which could be finance, could be asset management, could be insurance. It could also be traditional energy versus distribution. Let's think about pharmaceutical compared to Amazon and so on. So that disruption is only happening now, but is accelerating, and the speed is going to be brutal, which means there's going to be more deflation, which then triggers more central banks activity, which then triggers even more overinvestment in technology. And then secondly, and longer term, we will have plenty of credit crunch because of that. So when we talk about COVID, is literally the tip of the iceberg. The biggest trend underneath is this technological winter, which we think is going to be brutal and very, very disruptive for most of the companies, especially the one represented in credit. Let's not forget, credit is an economy that look in the rear mirror. Basically, it's companies that had their best days and they're just printing and printing. The interesting part will be to spot the ones that are going to go down because of these and be short about it. The second big event coming from COVID, if we move to the next slide, has been fiscal expansion. I think there are very few precedents in the history of humanity where we had such a violent monetary response actually supported by a fiscal response. Typically, those kind of combination have ended up in hyperinflation and have been, circumscribed to very small regional area. At the moment, this experiment is happening on pretty much a worldwide scale. What we notice with fiscal expansion, and that's true based on historical evidence, is that fiscal expansion is very easy to start, it's almost impossible to rein in. What we think is that what policymakers are doing is brilliant, is the right thing, and that's what saved not only the financial system but humanity for the last 11 years, since 2009. But the reality is that not everybody can afford that combined effort. We think America, barring constitutional crisis now with Texas in front of the Supreme Court, is one of the countries that can afford that. Japan, definitely. Europe as well, as long as they maintain the political unity that has produced the recovery fund. Away from those, whether it's China or United Kingdom or Canada or any other emerging market countries, within the market is really, in a way, dreaming that they are going to be capable to maintain this kind of in a combined effort. So fiscal expansion typically has an overcrowding impact on many other investments, and typically has to be funded sooner or later with increased taxation and creates inefficiency. It will be medium-term issues for most of the big economies, but for a lot of small economies or open economies, which are not part of a major bloc, it will be much more disruptive. How do we approach this? I think if we move to the next two slides, the first approach that we have is trying to be true to our roots, which has always been focusing on absolute return and relative value strategies. We like to think we're a little bit like a mini David in the big scheme of things at the moment, but because of that, we can be nimble, we can be more agile, we can have positions which are long or short, and like we've seen in this year, it does pay to be able to move quickly. We were very bearish January, February because of what was happening in China. We turned around quite quickly because we thought the amount of money and data and technology being used to fight the COVID would eventually have had the best out of it, and then we turned long. But if I look at the market going forward, I think that most of the strategies that worked very well for the last 5-10 years, effectively parity approach, like long fixed income, long equity, those are literally like Titanic strategies now. I mean, the chances that you are going to lose a decent amount of money over the next 2 to 3 years is very, very high. And we are approaching 90+% in our estimates. Especially when it comes down to credit, which, like I said before, is a representation of all legacy businesses. They are probably much more a victim rather than winners of the technological change. The second slide, which will show our focus, is our ability to select on fundamentals and events associated to that. I, use a bit of a provocation by picking up this picture of this lady picking the cards to predict the future. But if we go back for the last 5 or 7 years, it didn't really make much difference what you were buying. If anything, you should have just bought the worst kind of pieces of the credit or fixed income world, and the most momentum in the equity, and it would have worked very, very well. What we think will make a massive difference now will be the selection. And I think, in the past, it didn't really matter if we were picking a wild card out of that stack of cards because the market kept on going up. The problem now that I think, the amount of leverage which has been issued either by governments or by corporations is astounding. And so there will be much more issues with over-levered companies, overburdened company with funky accounting or business models which are just not going to be able to sustain the pressure from technological change. So that we think a massive opportunity for us. As always, the dream is to be short investment grade high yield kind of names when they're still very comfortably high up, like we've done with Wirecard. But at the same time, when the crash comes, and we've seen it many times, starting with Wirecard, the overshooting in terms of pricing can be brutal. In the case of Wirecard, we've seen the bonds going as low as 5 cents on the dollar to then recover closer to the fair value of recovery, which is 15. So our view is that the equity returns of the next 5 years will be available predominantly via distress and stress investing. The case of Wirecard, again, I'm referring to that because it's very much, clear to everybody. Yeah, it's 100% a fraud. We thought that for a long time, but you still have a situation where the overshooting on the security pushed them below the fair value of what will be the litigation claim. So in that case, you had bonds going down to 5, recovering to 15 within the space of 2 weeks. So you have like a 200-300% kind of return. We think it's going to be much more going forward. We had a few situation of stress and distress this year that work really, really well for us, many more that we're monitoring. We need to be patient, we need to be very disciplined, but there will be plenty of opportunities going forward. And I think that's where really we expect to see equity returns going forward for the funds is from the distress pocket, ideally short first, when it's very high up, and then buy them as a proper equity claim on the restructuring. And then secondly, obviously on the big new trends, which are alternative telecommunication and alternative energy. With that, we can move to the next slide. This is one is on macro. It's something that we're very, very focused on there. I think we've been talking about macro since the inception of the fund. We're very focused on there. There is a lot of excitement about the MMT theory. People that spoke with us since the beginning, they know we always been, a strenuous supporter of that, in the sense that, there is no limit to what the Fed or the ECB can do. And if anything, our view is that ECB and Bank and Japan will probably be the most favored macro bloc to exercise a proper debt cancellation of the holdings owned by the central bank. And they will be very positive. It will be a conditional cancellation, but it will be happening if the deflation keeps on going. But away from that, our point is the very few big guys that can afford that sort of combination of monetary and fiscal policy. And I think the next year or so will show that many countries cannot afford that. In our view, the only safe countries that can do that are Japan, America, and Europe. Everybody else outside of that inner circle would be at risk of major currency devaluation or currency volatility or speculative attack. And so we're very, very mindful of that, also because, and we try to put that picture of this dam, which was supposed to last forever and started having cracks after a few years. Let's not be complacent about the market structure. Market structure has changed. There's a lot of perceived liquidity. People invest on their mobile, on their app. They are levered. They use ETF and use its daily liquidity. The reality is the market structure is not like that, because the intermediary they don't even have a single-digit percentage of their ability to absorb risk they had before the financial crisis. Over those 10 years, their ability has been eroded, which basically means in that dam, we have lots and lots of cracks, and the water is building up very, very fast. So we think, there's going to be plenty of situations where different central banks will be called on their bluff. Some will resist, some will win and overwhelm the market attack. Some will not, and they may very well decide to let one or few parameters go, whether it is the currency or whether it is the rates on their government financing. And so that is something very important. We are not pre-committed to anything, but we're very mindful that given the valuation overall, effectively your expectation as a fixed income investor is to have a guaranteed loss over the next 3 to 5 years. And that is a very uncomfortable position to start with. irrespective of any, exogenous or politically engineered disasters. If we move forward, we then move into what we think is probably one of the 2 or 3 best kind of long opportunity that we see out there. We think there's been a lot of hype on anything related to the cloud. What we like to invest in is the actual, the dirty part of that kind of infrastructure, which is the telecom infrastructure, which has been, in a way, not very heavily invested for the last few years. Now there is a new disruptive technology, which is 5G. It will be very much invested. There will be a big discriminating factor across macro blocks, even in terms of their geopolitical influence and ability to project their power. 5G to us is probably going to be one of the most interesting assets over the next year or so. We think it's got all the criteria to become a proper bubble, but valuation at the moment are still very, very cheap. We just put down 2 of the strategic positions we have in the book. One is the Dish convertible. Within Dish has got plenty of spectrum. They have the ability to enjoy their technological virginity, being the latest to build the network, so they can take whatever latest technology they want, and they can be very, very competitive. We see the upside, in the 50 to 60% of our position. Is something that could go up even more than that. Oi Brazil, they got both broadband and mobile in Brazil, and it's a very fast-growing economy. There's a lot of other, investments in 5G. Another big investment for us this year, which we close, obviously, has been the M&A of T-Mobile and Sprint. T-Mobile has done a great acquisition, one of the few acquisitions that I think will come to history as a very transformational, positive, constructive. Our view on M&A, most of the time they destroy value, but T-Mobile and Sprint will probably be one of the most successful transition from like an old kind of mobile player to like a proper 5G player. If we move forward, we can then talk about the other big opportunity I discussed already. We think there's going to be plenty of credit stress, of credit crunches, credit waves. There's a lot of companies that are over-levered, a lot of companies that didn't protect their bondholders, a lot of companies that use funky accounting. Wirecard is the extreme. There's a lot of other companies that are not fraudulent, but they use accounting in a very aggressive way. We monitor plenty of those. There's a lot of companies that we've been long and short in the past, and actually we started having a position which is short, for example, on Arista on the equity side, initially as a starting point, and then we monitor for the entry point. When the bonds really collapse, then you have the ability to invest in the bonds, but the bonds actually are nothing else than the equity into a restructuring story, where the pricing regime moves from a liquidation game plan to an ongoing valuation, where basically your kind of multiple over earnings over revenue, they can really shoot up and multiply by 2 or 3. Those are 2 of the positions we still have. We've done plenty of stress and distress this year. We think there's going to be an amazing set of opportunities going forward. Those are names like Ferroglobe that more than double up. I think there's plenty more opportunity to make another 30-40% of the position. Similarly to Arista, obviously there was a bit of a COVID overlapping concept there. Obviously Ferroglobe produce some specialty commodities for the automaker industry. On the other side, Arista produce bread products for the likes of McDonald's. The reality is, I think there is a lot of plays that we can do, whether it's oil and gas or commodities, where we may be getting into a bit of a first quarter of roaring 20s. We think the market will be surprised how fast vaccine get deployed and become effective. We talk about 3 vaccines on our media. In reality, there's at least 5 or 6. The Chinese one may be less effective, but it's probably very much widespread, and it's probably prone to improvements given the big law of numbers. So we think there could be a lot of opportunity in distress and stress tactically now in commodity-rich sectors. Overall, distress would be a fantastic opportunity. So if we go back, the other slide that we're talking about is opportunistic M&A. Our view on M&A is always the same and is proven historically. M&A is the mother of most of the horrible disasters that we've seen, and always be mindful of a company that does too many acquisitions. Now, it does also offer great opportunity for us. We'll speak about Slack and the valuation later on, but when we saw the first rumors surfacing about Slack, we were really convinced Salesforce would have gone down that path. We think it's the wrong path overall, long term, but we were convinced they would have done it. So that obviously opened up a great opportunity for us. We bought it, quite cheap at the beginning. We probably made close to 10%, and then at the peak we sold it because we thought the valuation would have been insane, prohibitively expensive, and probably would have taken time for the research analysts to realize that it was probably the wrong acquisition and maybe actually a local peak for cloud-related plays. Similarly, we've seen with market, as soon as it was announced, we look at establishing a short on the position. We think, again, is a very overcrowded market. Valuation are, to us, very insane. And data is one of the places where we see zero barrier to entry. Not only that, but we see the big cloud guys, whether it's Amazon, Microsoft, and Google, being very aggressively entering that. They're very horizontal at the moment, while obviously market and IHS, they're very much vertical. But for horizontal player to decide which vertical they're going to go in and destroy competition, it will take very, very little. So M&A is a big thing for us. As always, because it's big companies, we can play through a variety of bonds and equity. We've done very well this year on T-Mobile Sprint. We've done very well on Tiffany LVMH. It's great opportunity there because credit and equity tend to price the events in a very different way with very different set of probabilities for some weird reason. Probably because very few people can play around the capital structure is one advantage for us, which we want to fully capitalize going forward. Slide 10 is quite important for us. Our predictions for 2021 is that there could be a very big crash on the Nasdaq. Several reasons for that. The main one, you can see them on those page. It's very simple, but the first one is if you look at the market where we are, we've been basically driven there by a bunch of companies, and the ones that are actually making money, they're Amazon, Google, Facebook, Microsoft. Those are really the cash flow generative one. Now, if you look at those guys, they all pretty much do exactly the same thing, and the addressable market is massive. Granted, so they can still go up, but Amazon on the cloud having a 55% market share, it only is going to go down. And what we see there, the problem we see is that these companies, they're all competing against each other. Zoom came up, Slack came up, WhatsApp came up, Microsoft during COVID built Microsoft Teams at a very disruptive pricing, pretty much, because it's effectively free almost compared to the others. So they're all competing on the same space. They all have unlimited budget. They all make money on personal data, which they don't pay for. They're all unregulated and they pay very little taxes. Not only that, but the important thing, if you look at their geographical distribution, they're very strong in their domestic market, but they've been pretty much shut out of China or Russia. And I think there'll be plenty of geopolitical tensions about how you're going to tax or regulate this guy, especially for governments going to need a lot of money going forward. So for the first time, we're at the peak of the market, which is pretty much driven by 4 or 5 companies. They all do the same thing, and they all pretty much don't pay taxes, or they're very few, very, very lightly regulated. So one big thing for us could be a big Nasdaq crash next year, either because regulation, because tax, because of barrier to entry. There's plenty of players that can come in. The barrier to entry in technology is very minimal, and technology is being skyrocketing in terms of their ability to disrupt. So again, going back to the point before, where every startup with a meaningful business plan can be funded and become disruptive, as long as rates stay very, very low, the overinvestment in technology will be massive, and that's overcapacity typically what's trigger repricing and correction. The flip side of that, we see it with Salesforce buying by Slack. We thought they would have done it because they're catching up. They're behind the Google and the Amazon of the world on the cloud. They're spending 28 billion for something that barely has got 10 million users. We made some math. They could have spent 2 billion to build in 3 months an infrastructure software-wise, which is better than Slack and better than WhatsApp, and then pay $1,000 for any customer signing up and using exclusively that platform. And that would have got them 26 million users instead of the 10 they got. instead, they like to pay 28 billion. Now, the interesting thing there is they didn't pay just with cash, they pay with a lot of debt, which again, from a corporate finance point of view, it's brilliant, makes perfectly sense, because it's effectively a reverse engineer share buyback. But the interesting thing is that, again, we're going to see a lot of debt finance acquisition, and a lot of those things that they're being bought now, they're bought at the wrong valuation, and they're not going to create the same cash because the competition in this sector is brutal and it's coming from the big guys. So that's something that we're really focusing. I think is, if I need to think about a one-off, you know, a 2 or 3 standard deviation kind of event for 2021, will be a big major Nasdaq correction. If we move forward, again, what we're trying to find overall is value into leaders, into the strongest trends. So we either look at special events like M&A or special seats or distress opportunity, and those are very idiosyncratic. But away from that, the big opportunity we see the big trends we see is 5G. And so obviously, you know, whether it's, you know, Sony, AMS, the Dish convertible, the OI Brazil bonds, you know, it could be Telecom Italia savings, you know, any of those, we're trying to find value, hidden value there. We think there's a lot of value in the telecom infrastructure. All the value so far has been pushed to the cloud guys. They're not really paying for the infrastructure, while the infrastructure need to make the capex, but they're not really getting much money out of it. But we think there will be a turning point in the fortune of this sector. So there's a lot of value for us in telco infrastructure and 5G. Fintech is a big thing for us. We're quite bullish on banks. We think there'll be excitement in the next 2 or 3 months about merger, acquisition, and all of that. Overall, we think the sector is doomed, as asset management and insurance are. Fintech is probably going to be very disruptive on those sectors. So it's something we're really looking at for finding niche longs like Cardlytics, for example, or Twitter, versus both convertible and equity, versus having shorts on more established players that will be very much affected by the COVID long-lasting loss provision, especially on commercial real estate, which again, if we need to think about 2001, another 2 or 3 standard deviation events will be a proper commercial real estate crack in terms of valuation and related funding. Again, on the cloud, we said, you know, we're very cautious of the big players now, but we like some of the small, you know, players like VMware, on the bond, on the equity side. There's plenty of stuff, and security. Away from that, the other big trend that we've been focusing on this year is alternative energy. We think it's probably going to be the longest trend that we seeing it, and I think unfortunately any accident on the weather side, to put it mildly, that we're going to see in the next future, which unfortunately I think is quite unavoidable, given where we're going, that will turbo accelerate again investment in alternative energy. The biggest investment we see overall is a total transformation of the energy infrastructure into hydrogen sooner or later. There will be pull and push, but eventually will happen. I think it's a bubble, so it's very dangerous, but I think is a bubble that's probably going to burst and rebuild many times in the future. So obviously we need to be very careful. One thing, again, going back to the same principle I said before about this kind of virtuous cycle, you're going to have a situation where a good business plan, look at a plug, for example, even Tesla. I don't like Tesla, but as a concept, the equity goes up so much that eventually you can actually sell the equity to believing investors. They're going to give you the cash to become real. They're actually going to give you the cash to make your business plan credible. So you can even start with a business plan which conceptually attractive but non-financially credible, but because people really believe in you, whether because there is an ESG ETF or because there is, you know, a crowd of investors on trading platform buying you, but you get to a point where you actually can sell it. And at that point, even institutional investors come in and you get enough money that you can then buy technology, which are very cheap now, but very disruptive. So Tesla did 3 capital increase this year, you know, Plug did 1 or 2, but there's going to be many other companies doing like that. And unfortunately, you have this mini virtuous cycle for single companies, but you put them together, and that virtuous cycle of specific companies cumulated becomes a very, you know, big headwind for the legacy businesses. So oil and gas is something that we look at a lot. We think there will be plenty of stress and distress opportunity. We think will be plenty of M&A there as well. We've been involved there with quite a few names this year, from Occidental to British Petroleum, to other like BTU and Peabody Energy. There's going to be plenty of stuff there to be played, either through events or fundamentals. The long trend is obvious, it's quite clear, but there will be plenty of volatility going through that. If we then move to the next one, we spoke about it many times. That's where we think there's going to be the equity-like returns going forward, is stress and distress. Plenty of opportunity there. Like I said, the dream remains, and has always been our approach consistently over the last few years, is to find an investment grade trading name and short it. The most recent for us has been Wirecard, where you have strong fundamental views, and then you set your catalyst in it and be very mindful of those and follow them to be able to short. Wirecard to me is something that people should think every day, because even after we had the lack of the audit report coming out because of lack of news, and even after we had the report coming through from the board, still the valuation were insanely high. We still managed to short stuff with the equity close to 80 and the bonds close to 70, 80. That it tells you how much this market is complacent, but how much it switches when the pricing switch from a liquidity pricing model, where there's liquidity, there is trading up, buying us, it's great, da, 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 da. When you move from there to, oh my God, there's a liquidity issue, there's no much in between. There were like literally 2.5 trading days where this stuff went down to effectively 5 cents on the dollar. Then it creates a major opportunity if you've done the work and you know that Wirecard will be a litigation claim, and it's probably worth, I don't know, it could be 10, it could be 20, who knows, but it's probably not 5. So at 5, we bought them back, and then we managed to exit at anywhere between 11 to 15. So we will see plenty of those opportunities. Again, Wirecard is the extreme. I look at other names, like, for example, to me, one big name in a yield is Netflix. There is a lot of those names where they go, the only reason why they could go ahead is because they've been buying customers using the yield market to finance. You know, the problem with those sectors, whether it's Netflix, is the competition. You got Disney, you got AT&T, HBO, you got Google, YouTube, you got Amazon, you got Facebook, you got TikTok, you got everything. You know, the physical amount of attention we have is limited, and a lot of those business models are based on us being able to look at them and click on an advertisement. There's a limited amount of that happening, and so there's plenty of those businesses where I think we'll see plenty of proper crash. So the dream, again, let's spot the investment grade name to short, and then when it gets destroyed, then we buy the stress opportunity. Obviously, we're trying to be as diversified as possible, but when it goes to distress level, even a 25 to 50 basis point position at the right entry level is something that can make a ×2, ×3 return. Then is more than enough in a diversified portfolio. Also, because our view is that we'll see plenty of credit crunch waves through different sectors. And again, the yield market has been massive. We've been involved with many names: Moby, WeWork, Marcolin, Selecta, pretty much all the airlines, American Airlines, Lufthansa. There's going to be plenty more coming up. It's just a matter of time. But I think that's where the real opportunity structurally as an asset class will be. So like I said, the alternative energy, alternative telecom as a long, big opportunity in stress distress, but with a lot of shorts and investment grade. And then big question mark, obviously, on the macro ability to sustain the picture, and obviously on the tech winter, we're very mindful of eventually the moment where the big guys will start cannibalizing one each other too much, too fast. We can then move to the next one.
Yeah, we are done with the slides. I'll ask to the audience if they want to make a question, just use the chat. And in the meanwhile, Filippo, I ask you just to comment on the performance attribution per sub-strategy for this year.
Yeah, the good thing about the performance this year has been very diversified. I think obviously we had a big boost from macro. We were very bearish in January, February, March. We started taking off the shorts gradually because we had a strong view that COVID would be a matter of time. We didn't expect to be over by the end of the year in terms of vaccine and everything. but we know we started removing quite quickly, and then we had opening trades on and about the US election that work well. Away from that, it was a very diversified bunch of names. We had 5G names, we have alternative energy name, we had distress events. I can't pinpoint a single big driver, but it's been a lot of, like I said, selected credit play through events and capital structure. And again, what is interesting for me is that obviously there's going to be plenty more going forward. Obviously, we had limited ability in terms of AUM to deploy, but we would have probably been able to add even more names in terms of diversification. So one good thing that I can see coming forward is that the market has really changed the landscape now from a super parity environment to a very dispersion kind of prone environment going forward.
So just a question from the audience is about the banking sector. You just touched it quickly during in the previous slide. So you said in the short term you have a positive view, less so in the longer term. So if you can just mention on some position for the fund, if you have it.
On banks.
Yeah.
Yeah. On banks, our view, obviously is we typically don't have or haven't had big position on banks this year. The view we have had on banks, for example, at the moment, we have some position on Cardlytics, which we've been playing through the year. We're trying to be into mini niche for fintech. In terms of banks, what we played has been Passkey. We had a few position, and then we made some profit, we reduced a little bit, and now we still have some. We've been liking UniCredit in both credit and equity, but so far banks has been relatively small. For us, it's more an opportunistic play into the M&A. We've been playing, the Bankia merger. We've been looking at UBS, Credit Suisse, but always around specific events. Our view going forward is that I think there'll be plenty of push for M&A and acceleration there for the next 3 or 4 months. Away from that, we think banks will be probably one of the worst places to be invested, especially in credit, especially with the LT281, because to me, the biggest long wave of distress will be commercial real estate. No matter what people say that people are going to go back to the office, I don't believe that, and I think the leverage on this structure is immense. So I think that is one big thing that we see as negative, and the other one, like I said, is fintech. Fintech is coming. It's the easiest place to disrupt. It's going to be insurance, asset management, finance, banking, lending. So, but I think for the next 2 or 3 months we'll play some M&A plays, long short typically.
In terms of major risks where you have hedges on at the moment?
This month, our performance has been a bit subdued. We're probably up, I don't know, 70, 80 basis points on the month. Most of it is because of hedges we have. The big hedges we have them because there's a big constitutional crisis potentially happening in US with the state of Texas, together with other 15 or 16 states suing other democratic states for the election, like Pennsylvania, Georgia, and so on, in front of the Supreme Court. We don't know if the Supreme Court is gonna give any merit to it, or if even gonna discuss that. But I think if the Supreme Court say yes, we will consider that. It will create a very different environment. Obviously, we have Brexit. Our view has always been the same. We think it's very unlikely they're gonna find a deal. I think it's more likely they're gonna say no deal, and then eventually they'll sit around the table come March, April next year. Brexit is a lot less relevant now than before, obviously, because we've had COVID, and everybody thinks you can have a lot of fiscal expansion and monetary expansion at the same time, and there is no cost associated with that, which, as I said, is true for the big economies. It's not going to be true for everybody forever. So at the moment, the main shorts we have, we're trying to express them via call option risk-free assets or different volatility plays. Again, going forward in 2021, like we had in 2020, and consistently with what we've done for the last 10 years, we will have a view for new air pockets. And like I said, probably the worst thing that can happen to this market is that the vaccine deployment and distribution is more effective because financial markets would then lose the biggest support, which is central banks, or at least they will start seeing some erosion in that support. And that is probably the worst thing that we can see in this market. But given where assets are priced, especially fixed income and lots of the equity, you're pretty much guaranteed to be losing money if you trade, if you have a long strategy only, long only strategy or parity strategy. You're pretty much guaranteed to lose money the next couple of years. So we will definitely have hedges, out of money put, or out of money call on different things that we think would move.
And just last question, in terms of the risk return profile for the fund, do you think it has changed something into the strategy? Do we have to expect more volatility for the fund?
Well, I think in terms of strategy, the strategy is the same. We just made the process more consistent, more robust. We use a lot of we have our own internal research, remote platform, so we're trying to use AI as much as possible. So the process is always the same. The risk return has changed because the market has changed. So in terms of risk, obviously the volatility in the market will go up. We'll have more events. It could be a weather event, it could be a political engineer event, it could be a trade event. We will have plenty of events going forward, and given the valuation, I think we will see more volatility in the market. So it's natural to expect a little bit more volatility also for us. I hope it's going to be good volatility from the way we are structured, because we're nimble, because we're trying to be relative value, because we're trying to have hedges. So I think that volatility should actually be good for us. What has changed obviously is the return, because I think what we were thinking would have been trend taking 3 to 5 years has actually been compressed in the space of 9 months. So when we look at technological winter, we look at fiscal expansion and possibly debt cancellation based on that, we see a lot of the trends we had in mind being turbo accelerated. So I think, in a way, that should create a higher returns for us with a very marginally higher volatility than what we had before.
Perfect. I think we pretty much cover all the themes and views in the market and in the focus for the fund. So we thanks everyone for participating today, and we wish you a Merry Christmas and a very good 2021. So thank you, Filippo.
Thank you, everybody. Thanks. Bye bye. Have a good day.
Bye bye.